What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's #2 economy. My name is Tony, let's jump in. Okay, happy Sunday everybody, good to be back. This week Singapore downgraded the crisis level of the pandemic for the city, scrapping all tests for incoming vaccinated visitors and limits on gathering sizes. And more loosening is to come. Hong Kong will open to non-residents starting next month, a sign the financial hub is taking some steps to ease up on the world's strictest pandemic travel rules. And it's not just Singapore and Hong Kong. Indeed, much of the world is slowly opening up as the worst days of the pandemic, it is hoped, is behind us. However, in China, despite high economic and political costs, the central government has doubled down on restrictions and lockdowns in pursuit of a zero cases policy, arguing, publicly at least, that, quote, life comes above all else, end quote. Shanghai is entering its fourth week of strict lockdowns imposed since the 1st of April, and on Friday officials confirmed that the goal of no community spread would need to be reached before any real opening up is permitted. A very high threshold. Hopes from the middle of this week that perhaps Shanghai's case growth was stabilizing were dashed on Saturday, yesterday, when the economic megacity of 25 million reported a surge in COVID-19 infections, including 2,736 symptomatic and over 20,000 asymptomatic cases, ending 5 consecutive days of declines. These are officially recognized cases, we should point out. The city also reported 12 deaths on Friday, and this climbed to 39 deaths on Saturday. Residents of Pudong, who saw loosening of restrictions earlier this week, were no doubt disappointed to see that of the 5 districts recording significant surges in daily caseloads, the Pudong new area registered the highest spike, with over 3,000 cases. Anger and frustration among many of the residents of Shanghai continues to build in some communities. We should keep in mind too, though, that there are some parts of the city where there has been some loosening of rules and are very well supplied both with food and medical supplies. But this is hardly representative of the entire city. I have over a dozen sources on the ground in Shanghai. About a third believe that things are modestly improving for them and their communities, whereas 2/3 approximately either think the situation is as bad as it was a week ago or getting worse. As we have discussed in previous videos, the economic cost of the lockdowns is enormous. According to a senior city official yesterday, business disruptions caused by COVID restrictions pulled down Shanghai's industrial output by 7.5% in March, year on year, the first decline in 2 years. So we can see here that even before the lockdowns were implemented, we remember they were implemented in April in Shanghai, Shanghai's industrial output was already hurting. Some factories operating under closed-loop rules have restarted operations in the last week though. Automakers including Tesla Inc. and SAIC Motor have restarted production lines. Most major chip makers are operating now too. Meanwhile, in the sensitive capital, Beijing, local officials said late Friday that 14 cases have been found in the wealthy district of Chaoyang as well as Shunyi. On Saturday, 22 new cases were discovered. A Beijing official today, Sunday, described the situation in the capital as grim. A lockdown in Beijing, as well as the Yangtze River Delta around Shanghai, would represent a serious escalation of an already highly costly state of affairs. We will continue to follow the Shanghai lockdown, the economic costs, as well as outbreaks and lockdowns across the country in the coming week. Okay, next up, in a financial milestone for the country, China is rolling out a truly private pension system for the first time. On Thursday, China's securities regulator hailed the new scheme, saying that it will waste no time in making rules to facilitate pension investment by mutual funds. The People's Republic of China runs what it calls a 3-pillar pension system, in which the first 2 pillars, the state-run basic pension insurance system and the employer-sponsored pension plans, hold almost all of the funds, where the third pillar, the personal pension funds, has traditionally represented a tiny part of China's total pension funds. With the rollout of this new private pension system, officials hope that households' wealth management preference for short short-term speculation may move to a more stable long-term retirement savings and investment strategy or focus, and that these three pillars may become more balanced. We will see. Analysts observe that part of the challenge for policymakers now lies in persuading individuals to allocate some of their earnings and invest in the new plan. Analysts with UK-based Financial Times argue that China is launching this private pension to, quote, unlock the vast savings stockpile, end quote, of the country, observing that China's approach will aim to move pension savings more directly into the country's financial markets, as part of wider opening up that has attracted some of the world's biggest investors to expand their presence in the country. Under the new plan, employees in China will be able to contribute up to 12,000 RMB a year, approximately $1,860 to private schemes. Okay, last up, we're going to be discussing the Chinese housing market, part of our ongoing coverage of the Evergrande crisis in the country. But as always, guys, if you're enjoying the content, don't forget to hit the like button. It's a huge help. And for anybody who wants to go the extra mile, or anyone who appreciates what I'm trying to do with this channel and wants to try and help make it sustainable, my Patreon, Buy Me a Coffee, and crypto links are in the description below. As always, everybody, thank you so much for the ongoing support. Yesterday, global ratings agency Fitch Ratings Singapore office published a detailed research note on the poor state of the housing market in China. The note observed that with more government regulatory easing and policy accommodation, general confidence in the primary housing market may improve from its current low base, but that the value of sales in the country is still set to fall by 25 to 30% in 2022. New housing sales among China's largest developers fell steeply in Q1 2022, with many registering declines of 30 to 45% year-on-year. Most financially distressed developers saw bigger declines of 50% or more. Buyers have been deterred by the possibility of further price declines, as well as the risk that financially distressed developers may be unable to finish incomplete projects. End quote. This forecast for the fall of sales in 2022 is steeper than the agency's previous projection made in December of last year. That was a 10 to 15% decline in 2022. Despite this, Fitch still maintains that Q1 2022 is, quote, likely to mark the trough, with the decline in housing sales moderating over the coming months, end quote. This confidence comes from the fact that policymakers have, quote, provided clearer support with home purchase restrictions and minimum down payment requirements being eased in a number of jurisdictions. Banks have also been encouraged to speed mortgage approvals since October 2021. End quote. Interestingly, Fitch has more optimism in the power of regulatory easing than domestic financial media does. The domestic Chinese language National Business Daily, in a piece on Friday, reported that in Zhengzhou, the provincial capital of Henan, the real estate market hasn't rebounded despite having relaxed rules for well over a month now. Analysts quoted in the report attribute the downward trend in the city to the weak purchasing power of households, something that viewers of China Update should not be surprised to hear, as we confirmed on Monday of this week that national consumption plunged in March. A real estate agent quoted in the report expressed that, quote, many clients are cash poor. Even if they have cash, they are worried for their job. They are not thinking of buying a home. End quote, and that those who do want to buy are waiting for prices to drop further. There is another critique that we need to make of the Fitch report too, one that the authors themselves acknowledge. The property forecast that they have, which is already anticipating significant declines in sales this year, assumes that the impact on housing sales from lockdowns, like we're seeing in Shanghai and other places, and COVID restrictions will be modest and recoverable within a few months. However, quote, that assumption could be challenged should pandemic-related lockdowns pose more systemic economic growth problems, end quote. The report also forecasts a development which we have been predicting since the crisis first erupted last year, that state-owned developers will gain significant market share at the expense of financially challenged, predominantly private developers. We will explore more on China's housing crisis tomorrow. See you then. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.